Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the existing home sales report and what that means for the housing market. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah.
It is great to be here. So we got the existing home sales report, and you wrote an article for HousingWire that said the savagely unhealthy housing market is back. That's terrible.
Yes, just when I thought I was out, they pulled me back in. And for those that don't know what the savagely unhealthy housing market, it's been actually an ongoing premise since the kind of the end of the summer of 2020. Back then, inventory levels had broken to all-time lows, and then what occurred was uh, understanding how credit channels run inventory channels. And, with years 2020 to 2024 being the biggest housing demographic patch ever recorded in the history of America, it was not a good spot to be in. But what occurred in 2021, which is funny now to think about it, everybody thought, well, nobody listed their homes during COVID. So with 3% mortgage rates and 2021, people are out and about doing their thing. Well, we'll get a massive increase in listings. Didn't happen, right? New listings data was trending at all-time lows. Demand was good. It prevented inventory from rising. And then October of 2022 was, the big concern is if demand picks up again, seasonality, demand rises into a low inventory seasonal period, prices can escalate. And that's what January, February, and March of 2022 was. It really is remarkable how during this 3-year period, even with a global pandemic, it was actually 2022 that was the most chaotic year. It wasn't COVID. COVID-19 recovery model was pretty simple, just people going back to what they were traditionally doing. But here, it's February of 2022. I said, that's it. I'm done. This, I think we ran as high as 75% of the market had like multiple bids, and convincing people that this wasn't because record-breaking demand. This is just too many people chasing too few homes. Nobody would believe that because rates were low, and they said once rates rise, this is all over. And the second half of 2022, we saw month-to-month price declines. We saw a waterfall dive in demand, and days on market actually grew past 30 days, which I was very happy about, right? For somebody who loves to see balance, that was a good thing. But then mortgage rates fell, demand stabilized, even with rates at 7% here. The market is slow, and demand is still stuck near 21st century lows, or near 21st century lows. But we're back to a teenager market. Why? Because the active listings data didn't really grow much. And in that case, you're just dealing with too many people chasing too few homes, and you get back from over 30 days to back to a teenager level. So those are the rules. I don't change them. I'm never endorsing any housing market that has days on market at a teenager level or under. You either have a massive credit boom, which is going to lead to a credit bust. We don't have that, of course, or you have too many people chasing too few homes. And just with basic visual skills, anybody could see what's going on here. We have 330 million people in America, and active listings, even with the biggest crash ever recorded in history, are still near all-time low. So that is why we brought back the savagely unhealthy housing market, because we're back to a teenager days. And so, somebody asked me a good question on Twitter, do you have a historical reference to this? And I said, yeah, you show the charts of median days on market, and it was a lot higher. And back in, 2011, it was 101 days. That's how long it took to sell a home. And now we're 18. Last year at this time, we're at 16 days. I think the all-time low was 14. So just, when you talk about something for so many years and something comes back to your model, then you just have to stick with it, unless you want to create something that says doesn't apply. And yep, savagely unhealthy housing market, too many people chasing too few homes, and sellers are buyers, and people are just staying in house.
I think it's interesting because I'm glad you defined it, because people would define savagely unhealthy as different things. For some people, that's, affordability. like when the affordability got so bad. For some people, it's whatever. But to you, it's like there's a problem when a house cannot stay on the market for longer than 19 days, because that shows other weaknesses, and it could be a variety of things. In this case, it seems like it's just inventory, correct?
Yeah, I mean, it was a hard concept for some people to get because they just think we had record-breaking demand last year or in 2021, and there was no like massive credit boom like we saw from 2002 to 2000. This is why, when I do those purchase application charts, there's always a black line drawn from 2002 to 2005. That was a massive credit sales boom. We cannot have that kind of market. But there's just people that just say, no way, when rates go up, the whole cars are going to fall down. And it just not the case. So now that we had the biggest collapse in history in home sales, and now that, home sales right now, they were up 0.2% month to month, but they're still trending at 21st century lows. I mean, if we took it this year, just the new home sales and existing home sales, I mean, we're near 5 million total home sales. If we had to close it today, that's near 5 million home sales a year. But it's not what we saw where existing home sales were at 7.2 million on the monthly prints in 2005. So the days on market being this low just shows that there's just not enough product available. And when sellers are buyers, and then if you have first-time home buyers coming in, they take some of the homes off, they don't provide one, you get stuck. And that's the whole concern. We've talked about this for years. My concern is housing getting stuck because the credit inventory channels were heading one way for over 10 years. Nobody cared about it. But here, the homeowners are just doing good. We just spoke at Gathering of Eagles, and I think, presenting those data lines in that historical context, and just saying that people are living in their homes longer and longer. Everyone's homeowners have this very low total housing cost, and it's not the turnover that people would think. So naturally, when demand stabilizes, here we are again. And I think, again, we track weekly data because we believe that if you want to be old and slow, then you wait for the monthly sales data. If you want to ignore forward-looking data like a lot of people did, then we're sitting here in June. I think one of the national economists, Ian Shepperson, he talked about, I don't understand why people think housing's recovery. There's going to be a huge home price crash, right? It's prices follow after the collapse of demand. That doesn't work. That model doesn't work, right? And there's a difference between economists, stock traders, and pure housing people, because housing people track housing daily, weekly, and they put all the variables into it. So you don't come here near July the 4th and say, what's going on? How did this happen? Because the market doesn't care that you're old and slow. They simply, it is a group of millions and millions of people, and intricacy of bond markets, commodity prices. The world doesn't stop because you don't want to follow data. So now that we're here, we're like, whoa, we're back to 18 days. That's crazy. Yeah. And it's not because home sales are booming, right? Home sales have been trending lower for months now after that one big print. It's just because product is not available.
So give us some historical context on, number one, what a normal, and let's say normal market would be. Let's go to 2019. Would you say that's a normal market? And talk about a couple of things. How many homes were sold in that year? And what was the inventory like in that year? Days on market, all that stuff. Like, compare this to what you think is the last healthy housing market.
So 2019 was so near and dear to my heart because home prices, on an adjusting to inflation basis, the equivalence of rent, was actually trending negative. That's like as perfect as you get. Like, if in my perfect world, home prices would grow negative year over year, but on a nominal basis, I realized you would still get some growth. That was like tame. There was days on market were over 30 days. We had 1.52 to 2 million active listings. That's perfectly fine if days on market are over 30 days. This is why I always say I just want the 2019 inventory back, because I actually wasn't a low inventory person in the previous expansion. A lot of people who know me, I've written about that. I never believed in the low inventory holding housing back. I call it nonsense. It's just when you have a low inventory problem, the days on market collapse and home prices escalate out of control. That did happen after 2020, but in the previous expansion, I mean, historically, like 2 to 2.5 million active listings. This is NAR data. This is not Altos, the one we use, but that's normal days on market, 30 to 45 days, in some cases over 60 days. I think the one adjustment we do have to make over the last 10 years is we're doing loans a lot faster than we used to. We can close transactions like in 11 business days or less. That wasn't the case back from 2008 to 2012. Sometimes it would take, 2-3 months to close a loan. And that's why the days on market back then was over 100 days, plus demand was weaker. So we've become more efficient and faster in closing transactions. So part of the decline in the days on market is that. But here it's not the case. We're not back to 2019. Like my life would be so much easier if we just get back to 2019 inventory. Like
Easier, but maybe boring, right?
Well, listen, boring is good. We've talked about this. Boring is a good thing, right? It's not, but some people make this, if we get back to 2019 levels, housing is going to crash. No, it's not. We had like here's a good example. Somebody asked me about the Altos data at Gathering Eagles, and they said, well, inventory is up so much. Well, we had 240,000 single family homes in March of 2022. That's it. We have 451,000. Back in 2015, we had 1.2 million. Were home prices crashing then? And then the person, something clicked. They're like, wait a second, you're right. Yeah, we almost had 3 times more active listings back then. Were home prices crashing? No. There's an equilibrium between supply and demand. And of course, in 2007, NAR data was 4 million. And now it's 1 million. I mean, the NAR data was actually negative year over year on the active listings. They track data a little bit differently.
When was it negative? When?
This report, the year over year inventory was negative. So, and again, I try to get people to focus on this downtrend in inventory since 2007. Like I have that long black line drawn from 2007 going lower and lower. So I just feel more comfortable with the housing market if we just get back to 2019 levels and days on market over 30 days, because people have choices, right? And now that we've seen the biggest home sale crash ever recorded in history, now that we've seen credit data look good during this whole thing, we could give up this fear about, massive home price crashes, foreclosures. But, I think the fascination and almost the illusion of happiness for 2008 from bearish American citizens. You just got to let it go and just go with the data. And we track this weekly for a reason. So if something turns, we can't miss it. We don't want to be 6 months later. Oh, guess what's happening? We week to week, day to day, we bond markets, purchase stats, we put them all together so people have a better understanding, because November 9th, everything changed. And I'm still trying to convince people today, Sarah, that this all started back then. I can connect the dots because why? We want to be the detective, not the troll. And I'm seeing economists like today or yesterday saying, wait a second, what's going on? How's this? And the data's already turned. And you just, 500 years ago, Sarah, you had to dispatch horses and you have to go get information that could come 3-4 months later because the horses got to come back. Your riders have to come back and it takes time. I get it. You can be 6 months behind, right? You have access to the internet and your phone can give you data within seconds. You don't need to dispatch horses. And this is why it's almost appalling to me that some people are still thinking it's the 2022 second half market. And they're surprised, and it's not like some Twitter trolling nonsense person. It's economists. It's wait a second, what's going on here? So it's in a sense it's complicated, but if you follow the daily and weekly data, the forward-looking data, connect the dots. It makes sense. And this is not a good thing. I savagely unhealthy housing market. I try to make the most straightforward term ever. Too many people chasing too few goods, and it's a hard problem to solve. And we just had the biggest home sale crash in history, and it didn't solve it.
So one part of the for other people savagely unhealthy is also, just the mortgage rates that we're trying to see lowered. What has the Fed said? What did they say this week? So we are recording this on Friday. This goes live on Monday. What did they say this week, and what do you interpret that to mean? Especially because we have some around the world. You have, other central banks raising rates. So what do you think is going to happen?
Speaking on that topic, in the UK, their Federal Reserve, or their Jay Powell, said, "You people should stop asking for raises. What's wrong with you? We're trying to defeat inflation. Stop asking for raises." So other countries are like the UK is dealing with a lot of inflation. That our growth rate of inflation is falling. So the Fed is kind of now, okay, maybe we have 2 more rate hikes. Some people say we're done. Some people will be calm. They'll make up terms that I just need to watch the data at this point. But we're kind of toward the end, or the end here in America. So I think overseas there are other countries that are trying to defeat inflation by they were going to stop, and now they're rehiking, and everyone is getting to that level. So remember, global yields to a degree fall with each other. So I think mortgage rates and the 10-year yield to me looks perfectly normal. I think the front loading of inflation data, and just remember that the 10-year yield was lower when we had 9% CPI inflation last year. So there are other things that are working with this channel. And the Fed is really, okay, maybe we have 2 more rate hikes. That's it. Maybe, but it's what happens next. And again, for me, it's all about the labor market. It's labor market and jobless claims. Right? That was the whole premise. The channel holds within that. And it wasn't like it wasn't tested, Sarah. I mean, we had what, 8 different times try to break that Gandalf line. So the labor market is what I'm tracking. And there's the leading economic index today, or that was in this week. It looks so recessionary, but I stress to people, when I did the risk 6 recession red flag model, when I wrote it on the day, I said 2 things can help this expansion, because demographics are different and credit balance sheets are different. The growth rate of inflation falling, check. Energy prices falling, check. That's a benefit to consumers. The Fed stopping Fed rate hikes, no, that hasn't happened yet. Maybe we have paused that now, so keep that in mind. And then cutting rates when the labor market gets weaker. We haven't got the labor market weaker yet, or we're not in cutting. Bond yields going back and forth, and mortgage rates stabilized housing. So I know people are frustrated with rates, but to me, it looks perfectly normal. I think the big variable this year was the financial banking crisis. That changed everything. It made the mortgage spreads worse. So I think that's the new thing. That's, if people are frustrated, Silicon Valley Bank and those people, right? That came out of the woodworks, and that was the reason mortgage rates are still higher than they should be. But again, I can make a case that the 10-year yield should be much higher, and mortgage rates should be much higher today than it is. So I don't do it because it's not part of my forecast, but people can surmise that where the growth rate of core inflation is, the 10-year yield should be higher. It isn't. To me, it looks perfectly fine. So we have to deal with this. I think I don't know anybody who's talking about a reacceleration of inflation here. The growth rate falling is perfectly normal with all the forecasts. And now comes the disinflation factor of shelter kicking in. So it's hard to reaccelerate. It's interesting because Larry Summers, who says we need to have higher unemployment to defeat inflation, which I am totally against the Summers camp or anybody. He talked about, oh my God, look, rent inflation is cooling off. Wow. So that's it's heartening. Of course it's cooling off. It can't sustain those levels. That's going to be the story for the next 12 months. It's, if energy prices keep on going lower, and I think there's a limit to what that does, because everyone doesn't want energy to crash. Um, we could work through this and see if the 10-year yield can break lower without having a job loss recession, just a cooling down of the labor market. But as of now, it looks normal to me. So Sarah, if I was here on December 31st, 2023, you know what I'd tell you? It's the same forecast. Right? I don't, because there is like the end of the year, I don't go, okay, the calendar year has changed. Here we go. No, I mean, the previous expansion, it was the same thing, 1.6 to 3%. I mean, it's not very exciting channels. They're not supposed to be, but labor, the jobless claims data has accelerated from the bottom. There are states that are showing higher jobless claims. Now, you could say some of this is fraudulent stuff, but in any case, the labor market is not as tight as it used to be, but it's not cracking yet. So that's why I focus so much on labor this year. That's why it was part of the forecast. The growth rate of inflation to me was already anticipated by the markets, and the bond yields are still acting in accordance to a global marketplace that is still other central banks are trying to deal with inflation.
Do you have I know that it's not explicit in your forecast, but like in your own mind, do you feel like we're going to see labor break by September, by December? But like, do you have a time period where you think we're going to see that?
You just go with the trends, and what's occurred is with housing stabilizing and permits slightly rising, um, we have a lot of other construction projects out there. A lot of people are just waiting for construction labor to break. There's nothing that actually shows the break, but it does show that the trend is getting there slowly. So you have to follow the weekly data. That's why, I said it was, it'll be interesting to see kind of September, October, November where jobless claims are at. But follow the weeklies, right? If you sat and said on X date something should happen and mortgage rates would fall and that didn't occur, then there's something wrong with the model. And I just think the financial crisis with banking changed everything. But here are a few things for people to think about going out for the rest of it. Number one, student loan debt payments are coming back in October. All right. So there's not enough time this year maybe to have that impact the economy in a bigger fashion. But that's something that, the bond market would get ahead of if they really thought that was going to be a problem. So when we get to October, November timeframe, it'll be more interesting because whenever you're asking people to pay a payment that takes money out of their pockets that they weren't paying. So I've talked about this before. If you really wanted to fight inflation, one of the things you would have done is had people pay their student loan debt because that takes money out of the system. Because asking the government to spend less, good luck with that.
Good luck.
Asking the government to say we're going to raise taxes on you, good luck with that one. Also, I mean, in an effective world, you could raise a Social Security tax and it would take money out of the system, and nobody's going to do that. So the only thing you had in your pocket was student loan debt payment. So that's why let's wait September, October, November timeframe, see how that goes. But we have a credit getting tighter. We have the commercial banking crisis and student loan debt pay. So we have things that are coming up. We'll see what they do. But the bond yields, I encourage everybody, be a nerd like me, go look at the 10-year yield, give it a year chart, look at 4.25, right? Because who is the crazy guy in the world that said, this is the peak? 4.25, take a black marker, draw that line all the way down to where we are today. Okay. And make sure that's not a permanent marker on your desktop. Okay. Or use your mouse. And then you might get something there. You might get where I'm thinking right now. And so we've obviously have not tested 4.25 this year. We got to 4.10% on the 10-year yield. So, but just take that black line, draw it, and see, something might be happening. So it is what it is, Sarah. It's a very complicated life after 2020. The previous cycle was so boring. It was so easy, but it was so boring. Here is just you're dealing with a lot of variables and things that could pop out of nowhere, right? The dollar is not as strong as it was last year, and I think for the markets, that's probably a positive thing. And things are just calmed down. They're just things aren't as violent as they were last year. Last year was nuts.
Last year was nuts, but I
Last year was
mean,
nuts. I mean, especially the second half of the year. I mean, there was, I mean, to think that a country like the UK could lose their pension funds overnight. I mean, imagine if that happened here in America. I mean, that was a really big crisis if that occurred. That just shows you how fragile um, anything can be. This is why I'm not a fan of Freddie and Fannie ever becoming publicly traded companies ever again, because for all the hype of X, well, Silicon Valley Bank, First Citizen Bank, they have enough capital. It doesn't matter, man. The markets can just chop your head off in a second. And then all of a sudden, every protection thing you had needed to be backstopped, or the Fed needs to come in. And part of the thing, actually, with the Federal Reserve is that they feel very confident they can pull levers to stop any economic crisis. And I think this is something that all of us need to think about in the future. I mean, COVID, they just threw they didn't throw a bazooka. They threw Godzilla and King Kong to fix the problem. And they believe they can do that if they need to. This is why they're confident that they can prevent any major job loss recession, that they can pull levers when needed.
I do think it's interesting to think about the fact that, the Fed giveth, the Fed taketh away. The only reason we had those super low rates was because of what they did in a response to COVID, which, we gave them credit for that, and as we should, because they kept this country running. They avoided a giant problem. But those super low rates, right? The unintended consequences then had a different outcome. And then now it's like, they've raised rates so much, and people are, understandably upset about that. If you're in the mortgage industry, you can feel like, wow, they're just targeting housing. But the reason that we had low rates in the first place was because of the Fed.
I'm gonna slightly disagree with you.
Of course, you could
Of
do it,
course,
Logan.
just for this one reason. People don't know this. We had 3.25% mortgage rates in the previous expansion. So it's not like we didn't have low rates in the previous expansion. I think this becomes a really, really complicated discussion, because on one hand, nobody believed the recovery. I mean, think of it, Sarah. How many times did we have to we're already gone on April 2020, and trying to get people to believe that the recovery was real? And then people say, oh, it's an L shape, it's a W shape. Oh, we're going into recession in 2020. Nobody believed in the recovery anyway, or the stickiness of how some of this data was actually getting better. It was still gonna stick to us. But in 2021, people thought, hey, the global markets still didn't think the recovery was there. So global yields were low. Even myself, when I wrote on February 2020, we need higher rates to cool housing, because this is not the market of 2005, but if global yields are low and nobody believes that the economy is recovering, I mean, we had to deal with forbearance. People thought home prices were going to crash because of forbearance. I mean, so I, I, I mean, the job is, we had the fastest labor recovery ever. That's a good thing,
Yeah.
right? People working are a good thing, especially when men don't work, bad things happen, right? So it's just, no, it's just, we want a tighter labor marketplace over always, because when people are working, they're producing something, they have lives. When you have unemployed, especially guys, nothing good happens. So I'm all for that. I I just think the history of global pandemics have taught us we have a very inflationary period and then a disinflation period, and we're just working our way through there. But other countries are having more issues than we are. Um, so the rates staying lower for longer, as somebody who was talking about, we need higher rates, the bond market just wasn't going to go. For them to go early and say, okay, we're going to be hiking without the assurance of the market is, and partly is that maybe they didn't even believe in the recovery either. Looking backwards in that can be difficult, because I know I had to convince people in 2021 that the recovery was real. I mean, I had tons of people say, oh no, this is all fake. Once the stimulus, so let's all remember, once the checks are done with, that's it. The U.S. is, I mean, we're sitting here in 2023 and people are arguing that the economy is too strong. that we need to raise rates. I mean, I had people in 2021 tell you that depression is coming. So it's easy in hindsight, but I think having a tighter labor market's awesome. I mean, people working, the prime age labor force for women are at all time. These are all positive things. And we're working through our way through inflation. And but higher, like the recovery after the great financial crisis was so slow. And it's just, you know, even though the majority of people were always working, getting back all those jobs lost took years. What was it, like 7 years to get that all back? Here it was just very sharp, and these are positive. We want a country of people working, not working.
I agree with you. Okay, we are out of time today. We will talk again next week. And obviously, the housing market tracker coming out on Sunday. Of course, people are going to be hearing this on Monday. But check that out, because we look at purchase apps, we look at inventory, and we look at
And today is Logan Day. So there's, if you wanted a discount code to all the charts and all the nerdy work, you can get it. Again, the housing market tracker is designed for all of you to look forward, not backwards or on the spot. So when something turns, you have an idea. So you're not acting like a certain economist who goes, "What's going on here? Why are people talking about a recovery? It's home prices have to be crashing this year." No. Follow the data. Math,
follow
facts, and
the
data win.
data. And you can get that from HousingWire, because we're using our data and Altos Research data, which is amazing. And yes, Logan Day. Sign up for HW Plus. Thanks, Logan.
Thank you.